5 countries, 5 currency collapses, 5 sets of ordinary people who saw it coming, not because they had access to privileged information, not because they were economists or insiders, but because they were paying attention to the right signals while everyone around them was looking somewhere else. What they did in the 12 months before everything broke is the most useful financial education you will never receive in a classroom. Because the classroom teaches you how money works when the system is functioning. What I'm about to show you is what people actually did when the system stopped. Here's the pattern that runs through every single one of these cases, and that nobody in mainstream finance wants to reduce to a simple sentence, because it makes the entire industry sound optional. The people who came through currency, collapses intact, did not find a better investment. They found a different structure. They moved from assets that depended on the collapsing system to function, to assets that functioned independently of it. That transition, made quietly, made early, made before the crisis was visible on the front page of any newspaper, is the entire story. 5 countries prove it. The forensics are all there. Let's go through them one by one. Chile, 1973, the 12 months before September 11th. Most people know September 11th, 1973 as the date of Augusto Pinochet's US-backed coup against Salvador Allende. What the political history tends to obscure is the economic environment that preceded it, because that environment is a masterclass in what a currency in terminal decline actually looks like from the inside while you're living through it. By late 1972, Chile's annual inflation rate had crossed 160%. The escudo, the national currency, was being printed at volumes the central bank could barely track. The Allende government was funding nationalizations, social programs, and wage increases simultaneously through monetary expansion because orthodox financing had been cut off by U.S. economic pressure following the nationalization of copper mines. The result was a textbook monetary death spiral. More escudos chasing the same goods, prices rising faster than wages, real purchasing power evaporating while nominal account balances stayed technically intact. The Chileans, who preserved their economic position in the 12 months before the coup, did specific, documentable things. The first was dollarization of savings. Black market dollar exchange had been operating in Santiago since at least mid-1972. The official exchange rate was being held artificially by the government at levels that bore no relationship to the real purchasing power of the escudo. The gap between the official rate and the street rate, what economists call the black market premium, reached several 100% by early 1973. People who understood that gap, who converted escudo savings into dollars through informal channels, despite its technical illegality, preserved their purchasing power through both the hyperinflation and the subsequent political upheaval. The second behavior was hard asset conversion. Santiago's real estate market showed a documented surge in property transactions throughout 1972 and into early 1973, specifically in properties with productive capacity, agricultural land outside the city, commercial buildings, with existing tenant income, anything that generated real economic output independent of what the escudo was worth on any given morning. The academic literature on Chilean economic history from this period, particularly work by economists at Universidad de Chile, documents this flight from monetary assets to productive physical assets as one of the most consistent behaviors among households that survived the transition economically intact. The third behavior is the one that sounds the most ordinary and is actually the most important. Inventory accumulation. Chilean households in 1972 and early 1973 began stockpiling durable goods, cooking oil, sugar, flour, canned goods, soap, medicine, at rates that exceeded normal consumption patterns by measurable margins. This was not hoarding in the pejorative sense. It was rational economic behavior in an environment where prices were rising faster than the ability to earn. If a kilogram of sugar costs twice as much in 3 months, buying 6 months of sugar today is a 50% return on that specific purchase. The real return on holding physical goods exceeded the real return on holding currency by an enormous margin, and enough Chilean households understood this clearly enough to act on it that the pattern shows up in consumption data from the period. What Chile teaches is the inflation playbook. When a currency is being printed to fund political commitments that cannot be funded through taxation, the signal is visible months before the terminal stage arrives. The people who read that signal and moved from monetary assets to dollar assets, productive real assets, and physical consumables came through. The people who trusted the official exchange rate and kept escudo savings in Chilean banks came through with the nominal number intact and the purchasing power gone. South Korea, 1997, the 12 months before the IMF call. The South Korean won crisis of 1997 is studied in economics programs as a textbook example of contagion. The Thai baht collapsed in July 1997. Capital fled emerging Asian markets. The won came under pressure. By December 1997, South Korea was negotiating a $57 billion IMF bailout, the largest in history at that point. The won lost 50% of its value against the dollar in a matter of weeks. But here is what the contagion narrative flattens. The crisis did not arrive without warning. Korean households and businesses had 12 months of visible signals, and the forensic record of what the most financially resilient among them did during that period is remarkably specific. The first signal was corporate debt. Korean chaebols, the massive industrial conglomerates that dominated the economy, had been borrowing in foreign currency at rates that assumed one stability. By late 1996, the debt-to-equity ratios of major chaebols were running at levels that would have been considered insolvency in any Western accounting framework. Hanbo Steel collapsed in January 1997. Sammy Steel followed in March. Kia Motors was technically bankrupt by July. These were not small companies, and these were pillars of the Korean industrial economy, and they were falling in sequence throughout 1997, months before the currency broke. For any household paying attention to business news, the signal was there. The Korean households who protected themselves did something that cut directly against cultural norms that had been in place for a generation. They converted one savings into foreign currency assets. Korean financial culture in the 1990s strongly favored domestic bank deposits. The savings rate was extraordinarily high, but it was directed almost entirely into one-denominated accounts in Korean banks. The households that broke from this pattern in the 12 months before the crisis, who moved portions of savings into dollar-denominated instruments, foreign currency deposits at Korean banks that offered them, or physical dollars held outside the banking system entirely, preserved their purchasing power through the 50% devaluation. The second behavior was property over financial assets. Korean real estate, particularly residential property, is deeply embedded in the culture as a savings vehicle through a unique rental system called jaunts, where tenants pay a large lump sum deposit rather than monthly rent, essentially lending the property owner a significant sum interest-free. Households that converted liquid won savings into jaunts deposits or direct property ownership in the 12 months before the crisis locked their wealth into an asset that retained real value through the devaluation far better than one cash or one denominated bonds. The third behavior was debt elimination. Korean households with foreign currency denominated debts, mortgages, or consumer loans tied to dollar or yen rates faced catastrophic payment increases when the won halved in value. The households that had aggressively paid down or eliminated foreign currency exposure in the preceding months were structurally protected. The households that had taken on additional foreign currency debt during the boom years, attracted by the lower nominal interest rates, were devastated. The crisis did not discriminate between careful and careless in aggregate. It discriminated surgically between those with foreign currency liabilities and those without. What South Korea teaches is the contagion playbook. When the currency of a deeply integrated export economy comes under external pressure, the signal appears first in corporate balance sheets, not in retail financial data. The chaebols were visibly insolvent months before the one broke. The households that read corporate distress as a leading indicator of currency distress and acted accordingly came through. The households that trusted the one's historical stability and waited for official reassurance came through with their savings cut in half. Bolivia. 1985, the 12 months before the stabilization. Bolivia's hyperinflation of 1984 to 1985 is one of the most extreme in modern Latin American history. At its peak in 1985, annual inflation reached approximately 24,000%. That number is so large it loses meaning. Let me give it meaning. A product that cost 1 Boliviano peso in January 1984 cost roughly 240 Bolivianos pesos by December 1985. A worker who received a monthly salary and spent it over the course of a month, rather than immediately, was losing real purchasing power with every passing day. Not over years, not over months, over days. The 12 months before the Paz Estenssoro government's shock therapy stabilization in August 1985 were the most extreme phase of this collapse. And the economic behaviors of Bolivian households and small businesses during that period were documented by economists from Harvard's development program who were on the ground advising the government. That documentation is unusually specific and unusually honest. The first and most universal behavior was velocity. In hyperinflation, the rational response to holding currency is to hold it for as short a time as possible. Bolivian workers in 1984 and 1985 were negotiating to be paid daily rather than weekly rather than monthly. Employers who could arrange daily payroll were more attractive than those who couldn't. The moment wages were received, they were spent not on discretionary goods, but on anything with physical durability that could hold value better than paper. This is documented in Harvard development research from the period. The velocity of currency circulation in Bolivia during peak hyperinflation was among the highest ever recorded for any economy in peacetime. The second behavior was dollarization at every level. The dollar had been operating as a parallel currency in Bolivia's informal economy since the early 1980s, but by 1984 and into 1985, it had effectively replaced the Boliviano peso as the real unit of account for any transaction of significance. Landlords quoted rent in dollars. Merchants priced goods in dollars and accepted pesos only at the current black market rate. Workers with any bargaining power negotiated dollar-denominated wages. The people who had accumulated even modest dollar holdings before the terminal phase of the hyperinflation were, by Bolivian standards of that moment, wealthy. The people who had trusted the official banking system with peso savings came through with numbers that had not changed and purchasing power that had effectively ceased to exist. The third behavior was productive asset accumulation, specifically agricultural land and livestock in rural areas. Bolivia's rural population, which had long maintained subsistence agricultural capacity that urban populations had abandoned, showed dramatically higher economic resilience through the hyperinflationary period than urban households dependent entirely on the monetary economy. A family with a plot producing food and livestock was insulated from food price hyperinflation in a way that an urban family with peso savings was not. The knowledge of food production, like the dacha knowledge in Russia a decade later, proved to be a form of wealth that inflation could not reach. What Bolivia teaches is the hyperinflation playbook in its most extreme form. At 24,000% annual inflation, the deterioration is not gradual enough to miss. But the Bolivian case shows that even in the most extreme environment, the same behaviors that worked in Chile and Korea worked there too. Dollar conversion, productive physical assets, elimination of exposure to the dying currency unit. The mechanism is identical across all three. Only the speed differs. Iceland, 2008. The 12 months before the banking collapse. Iceland is the outlier in this list in the most instructive possible way. It is the only one of these 5 countries where the currency collapse was preceded not by government money printing or sovereign debt stress, but by private banking excess. And it is the only one where the government that followed chose a path that every other Western government in 2008 refused to take. Iceland let its banks fail. It prosecuted its bankers. And it recovered faster than Ireland, Greece, Spain, or Portugal, all of which chose the opposite path. But before the collapse, in the 12 months between roughly late 2007 and October 2008, the signals were visible to anyone willing to look at them. The 3 major Icelandic banks, Kaupthing, Landsbanki, and Glitnir, had collectively accumulated assets worth approximately 10 times Iceland's entire GDP. They had funded this expansion primarily through short-term wholesale borrowing in international markets, meaning their liability structure was extraordinarily fragile. They owed enormous sums in foreign currency on short repayment cycles. If the international credit markets froze, which is precisely what happened after Lehman Brothers collapsed in September 2008, those banks would be unable to roll over their debts and would fail within days. The structure was not hidden. It was visible in publicly available bank filings throughout 2007 and into 2008. Several international analysts, most notably analysts at Danske Bank and independent economist Roger Boys, had published explicit warnings about the Icelandic banking system's fragility as early as 2006. The Icelandic government had been warned by its own central bank. The question was not whether the information existed. It was whether ordinary Icelanders were willing to act on information that the official narrative was actively contradicting. The Icelanders who came through the 2008 crisis with their personal finances intact did several specific things. The first was foreign currency mortgage elimination. Iceland's housing boom of the 2000s had been partly financed through foreign currency mortgages, primarily in Japanese yen and Swiss francs, because interest rates on those currencies were lower than on Icelandic krona loans. When the krona collapsed, losing approximately 50% of its value against the euro, those foreign currency mortgages effectively doubled in krona terms. Households that had refinanced into krona-denominated mortgages in the preceding months, even at higher nominal interest rates, were structurally protected. Those that held foreign currency mortgages were not. The households that made this refinancing decision before October 2008 did so into official headwinds. The banking system was still presenting itself as healthy. The government was still projecting stability. The decision to act on structural analysis rather than official reassurance is what separated those households from the ones that lost everything. The second behavior was foreign asset accumulation. Icelanders with the knowledge and access to hold savings in foreign currency, particularly euros and dollars outside the Icelandic banking system, preserved purchasing power through the krona collapse. The Icelandic capital controls imposed after the crisis froze assets held inside the domestic system. Assets held outside were unaffected. The people who had moved portions of savings offshore before the controls were imposed came through. The timing window between the crisis becoming visible and the controls being imposed was measured in days. The third behavior was equity reduction. Icelanders who had borrowed heavily against rising property values to fund consumption and investment during the boom years found themselves in the same underwater position as American homeowners in 2008. The households that had used the boom years to pay down debt rather than accumulate, it had a fundamentally different experience of the collapse. Not because the crisis didn't touch them, but because they came into it with equity rather than leverage. What Iceland teaches is the private banking collapse playbook. When a small country's banking system has liabilities 10 times the size of the national economy, denominated in foreign currency, funded by short-term international borrowing, the system is not stable. It is one credit market freeze away from total failure. That structure was visible in filings. The people who read filings and acted on what they showed came through. The people who trusted the reassurances of the institutions whose survival depended on those reassurances being believed did not. Cyprus, 2012 to 2013. The 12 months before the bail-in. Cyprus is the most recent and, in some ways, the most instructive case on this list, because it introduced a mechanism that had not been used in any modern Western economy before it, and that every depositor in every country should understand as a permanent possibility. The bail-in. The legal seizure of depositor funds to recapitalize failing banks, not as theft, but as a formal regulatory tool executed with the full endorsement of the European Central Bank, the European Commission, and the International Monetary Fund. The background. Cyprus had become a major offshore financial center, particularly for Russian and Eastern European capital. Its banking system had assets roughly 8 times the size of the Cypriot economy, the same structural problem Iceland had faced 5 years earlier. Cypriot banks had also made the catastrophic decision to load up on Greek government bonds, which were then subjected to the 5% haircut in the Greek restructuring of 2012. That haircut effectively made Cyprus's 2 largest banks insolvent. The Cypriot government did not have the resources to recapitalize them. The European rescue mechanism was unwilling to provide a full bailout without conditions. The conditions that were eventually imposed in March 2013 included something that had never been done before in a Eurozone country. Deposits above 100,000 euros at the 2 largest banks were seized and converted into equity in those banks. Depositors above the threshold lost between 40% and 60% of their savings overnight by government decree. The deposits were not stolen in the street. They were restructured in a conference room in Brussels with legal instruments and formal documentation. The outcome for the people who held those deposits was identical to theft. The 12 months before this event, between roughly early 2012 and March 2013, contained signals that were again visible to anyone willing to read them. The Greek bond haircut of February 2012 was public information. The exposure of Cypriot banks to Greek debt was disclosed in their annual reports. The mathematical consequence that the haircut had rendered those banks insolvent required no insider information to calculate. It required only the willingness to do the arithmetic. The Cypriots and foreign depositors who protected themselves did specific things. The first was distribution below the insurance threshold. The 100,000 euro deposit guarantee was the formal protection level. Depositors who understood that the banks holding their money were technically insolvent and who distributed their holdings across multiple institutions and multiple jurisdictions to stay under the guaranteed threshold were fully protected by the existing insurance framework. The people who concentrated large deposits in the failing banks because those banks were offering attractive interest rates to attract and retain deposits, as distressed banks reliably do, lost 40 to 60 cents on every euro above the threshold. The second behavior was foreign jurisdiction transfer. Depositors who moved funds to banks in other Eurozone countries, Germany, the Netherlands, Luxembourg, in the 12 months before the bail-in removed themselves from the reach of the Cypriot regulatory action entirely. The bail-in applied to deposits held in Cypriot banks. It could not reach deposits held in banks regulated by other jurisdictions. The capital controls imposed after the bail-in froze movement of funds within Cyprus. Funds already outside Cyprus were already outside the freeze. The third behavior was the one that required the clearest reading of the political environment. Several large depositors, particularly Russian corporate entities, whose Cyprus exposure was widely reported in financial journalism throughout 2012, withdrew significant funds from Cypriot banks in the months before the bail-in. This is documented in Central Bank of Cyprus, data showing deposit outflows from the major banks throughout the second half of 2012. Whether those withdrawals were based on insider information or simply on the public arithmetic of Greek bond exposure is a question that Cypriot parliamentary investigations examined without definitive conclusion. What is not in question is that the outflows happened, that they were substantial, and that the depositors who executed them before March 2013 were not subject to the bail-in. What Cyprus teaches is the bail-in playbook. It teaches that the 100,000 euro deposit guarantee is not a ceiling on protection. It is a floor on exposure. Anything above it, in a sufficiently stressed banking system in a sufficiently small economy, can be reached by regulatory instruments that have now been formally established as legal precedent within the Eurozone. It teaches that the interest rate offered by a bank is information. A bank offering significantly above market interest rates to retain deposits is a bank that needs deposits because it cannot fund itself through normal channels. That is not an attractive savings opportunity. It is a distress signal, and it teaches that the window between the crisis becoming mathematically visible in public filings and the controls being imposed that prevent you from acting is often measured not in months, but in weeks. Here's what these 5 countries, across 5 decades, across 5 completely different types of crisis, actually demonstrate when you lay the forensic record next to each other. The people who came through did not predict the future. They did not have privileged access. What they had was a specific and practiced habit of reading structure rather than narrative. The official narrative in Chile said the escudo was stable. The structure of the money supply said otherwise. The official narrative in Korea said the won was fundamentally sound. The structure of chaebol balance sheets said otherwise. The official narrative in Iceland said the banks were well capitalized. The structure of their liability profile said otherwise. The official narrative in Cyprus said deposits were protected. The structure of the bank's Greek bond exposure said otherwise. In every case, the narrative came from institutions whose survival depended on the narrative being believed. In every case, the structure was visible in public documents to anyone willing to read them. The gap between those two things, between the official story and the structural reality, is where financial collapses are hidden while they develop. And the gap always closes. The only question is whether you close it on your terms or on the terms of whatever event forces the reckoning. None of these people were wealthy to begin with. The Bolivian worker negotiating daily wages to preserve purchasing power was not a sophisticated investor. The Korean household converting won deposits into foreign currency was not running an arbitrage desk. The Cypriot depositor distributing savings below the insurance threshold was applying a rule that was printed in the bank's own documentation. What they all had was the same thing. They were willing to look at what was actually there rather than what they were being told was there. And they were willing to act before the crowd did, when acting was still possible, when the window was still open, when the exit door had not yet been welded shut. By the time the lines formed outside the banks in Nicosia in March 2013, the people who needed to act had already missed their window. The deposit was frozen. The withdrawal was denied. The savings were restructured by decree. The window had been open for 12 months. It had been open the entire time. Subscribe if you want to keep reading structure before the narrative catches up with it. We do economic autopsies here, so you don't become the next case study.